Most fundraising advice will make you a better pitcher, but it might not get you an investment, and almost nobody talks about the difference. So founders, like, when you're trying to raise funds, they tighten the deck, they do all sorts of things, visual enhancements, they practice every single question, they predict questions, maybe they ask different AI tools to ask questions pretending to be an investor. They run through hundreds of different scenarios, and they nail the pitch and have all the answers to the questions in mind, and you name it, right? They try to do everything to optimize the deck to better their chance of getting an investment, right? And they still don't get the term sheet, and people just wonder why. And then eventually self-doubt starts to creep in, and then founders start to second guess themselves. And I think it's something that's worth addressing. So the common belief is, like, if the market is big enough, that means people will just come and buy my product, right? I don't have to worry about it. So they just fix the slides to make it appealing to the investor. They practice objections, they prepare for every question. This sounds like the right process, right? And to a certain extent it is, but the thing is, founders are optimizing for the wrong thing entirely. So in this video, we're just gonna go through common mistakes that founders tend to make when they're trying to pitch to investors, and things that they can optimize, or have a different mindset when approaching this. So let's dive into it. So each and every investor have their own thesis of what they believe in, and investors get pitched on a daily basis. So in their mind, they already know what sort of a founder to back, what sort of a company that they're going to invest in. What actually happens when you're pitching in the first few minutes is they're trying to fit you into that puzzle. The investors are pattern matching. So they're trying to see if you as a founder is someone who is capable of executing that said vision and the belief they have. So the deck doesn't really change it, right? It gives them the information they need, but beyond that, it does nothing. No matter how many agonizing hours you spend changing the designs or hiring so many designers and trying to make best pitch deck, in the end, it doesn't matter, because investors are looking at something else. And what ends up happening after the first maybe 10 minutes of your pitch is all the follow-up questions, the due diligence, the everything that they ask, the objections they have, everything is after they have made the decision. So either they are building a case as to why they should invest in your company or why they should not invest in your company. That's another interesting thing to keep in mind when you're pitching to VCs and investors. So this is something that every founder knows, and that is, a warm introduction always beats a cold DM. And it makes sense, right? Because if someone's approached through a cold DM or a cold email, what's going to happen is they're going to be approaching your pitch with a lot of skepticism. But when you're coming through a warm introduction, they're trying to look for reasons to say yes. And that's because you came through someone they trust, someone they work with, someone they admire. So this is why when you're coming through warm introductions, it typically has a higher success rate. So if you're raising funds through VCs or even angel investors, always try to do whatever you can to approach them through a warm introduction. And I can guarantee you your success rate of that pitch will drastically go higher. All right, the next thing. When an investor asks you, what's your GTM? They're not expecting you to lay out the entire roadmap and take up all the time, essentially. What they're looking for is to get an answer of, have this person talk to enough customers? Do they know if they are actually willing to buy? Do they have people who maybe pay deposits? They're trying to see if you have gone to the extent of validating and getting that initial customers, which are really hard to get. And the GTM is just one example. So if a founder asks you, who else are you talking to? They're not trying to be nosy. They're again trying to gauge okay, are there other VCs that they're pitching to? Are there a genuine interest in that? Should we actually accelerate our investment process? They're trying to get those answers and see if there's something much more deeper. It's very hard to give a lot of examples of this. I think it's something that you have to think on the spot. It's a gut feeling. You can tell your GTM plan, but you also have to tell why we are doing this. Why did you come into this decision? Why did you decide to target this specific ICP? Try to go deeper into the question. That's how we're going to convince those investors, those VCs, that you know what you're doing. And just always remember, right? They're not trying to get surface level answers. They want you to dive deep into it. All right, optimizing your deck is not useful, but there are so many other things that you can do to better your chances of getting that term sheet. The easiest thing to do is to go on like LinkedIn Sales Navigator and type up all the VCs, get a list, and try to reach out to them. But the real work is finding the investors whose thesis and your company matches. So you have to do a lot of research into what the investors usually say, what their customers say. You just have to look into what they have funded previously, what type of businesses were they in, what did they exit, what sort of founders do they work with, and just to similar to them trying to find a pattern in you, you have to figure out their pattern. So once you figure that out, you can just easily position yourself as the next part of that pattern or the path that they're building towards. So it's like your casting essentially. Like you have to find people who are already looking for you. So if you find an investor who's actually looking for you, your job is going to be so easy. You just have to convince them that you are the one who can take this company forward, that you are the solution to this problem. Okay, I'm going to give you a few actions that you can take before you approach your next few investor meetings. First thing is, you obviously find the person you will be pitching to. It might be a little bit challenging if you're pitching to like a large VC organization, but more likely you will know who's going to be taking the meeting. So look at their tweets, look at their podcast, like whatever digital footprint they have, go through as much as possible, especially the recent ones. Their belief will always keep coming back. If it's a tweet or if it's even a rant on LinkedIn or whatever, they're still going to be talking about it. Just take note of that belief. And you have to open your pitch by connecting to that belief. You cannot look at it like you're tricking that person or deceiving them, but essentially you are framing your own story in a way that fits their thesis and their beliefs. So that's how you can easily bring down the gap between a good pitch and a funded one. It's just a lot of research that you have to do at the start. Typically, founders who struggle to raise, they're not building bad companies. Honestly, they are pitching to investors who were never going to fund them, and that can be a very demotivating phase as well, because nobody tells you like that's the real problem. So yeah, that's all we have for today. Join me in the next video. I'll see you in that one.